Hello everyone, and welcome back to the channel where we demystify the markets and bring you actionable insights into the world of hard-to-borrow stocks and short squeeze potential. Today, we're diving deep into a fascinating micro-cap ticker that recently popped up on our screeners, GITS or GITS. We'll break down exactly what's happening with this stock and what makes it noteworthy. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show company logo / symbol GITS. Let's talk about GITS. This is a microcap stock with its sector currently not specified or publicly disclosed. While specific sector details are unavailable, its microcap status immediately tells us it's typically less liquid and can be prone to higher volatility when interest sparks. Our internal composite squeeze scorer, which weighs factors like cost to borrow, borrow supply, float, and price momentum, currently assigns GITS a score of 42.5 out of 100. This score indicates a moderate level of potential interest, particularly given some of the underlying metrics we're about to discuss. What is cost to borrow and why it matters? Before we get further into GITS, let's quickly explain what cost to borrow means and why it's a critical signal for potential short squeezes. When you want to short a stock, you essentially borrow shares from a broker and sell them, hoping to buy them back later at a lower price for profit. But borrowing those shares isn't free. You pay a fee, typically expressed as an annualized interest rate as your cost to borrow, or CTB. This fee is paid to the lender of the shares. The higher this fee, the more expensive it is to hold a short position, and often, the more difficult it is to find shares to borrow. When a stock becomes hard to borrow, it means there's high demand from short sellers or limited supply of shares available to lend, pushing the CTB rate sky high. And yes, these fees can absolutely exceed 100% annually, sometimes even reaching into the thousands, as we often see with strong short interest. Why this stock is hard to borrow right now. Now let's look at GITS specifically. This stock has hit our hard to borrow screener with an astonishing annualized cost to borrow fee of 932.3%. Highlight CTB number on screen to put that into perspective. Short sellers are currently paying nearly 1000% per year just to hold their positions in GITS. This signals an incredibly high demand to short the stock relative to the supply of shares available to lend. While we don't have data on the momentum of the CTB or the exact number of shares currently available to borrow, that 932.3% figure alone is a huge red flag for short sellers. With an estimated float of just 2.4 million shares, any significant short interest in GITS could quickly make shares very scarce, intensifying the borrow fees further. It's important to note, however, that despite this extremely high CTB, GITS has seen very little recent trading activity. Today's volume sits at 0 shares, with a 30-day average volume also at 0 shares. This means its relative volume is 0x average. Price-wise, we've seen plus 0.0% today, plus 0.0% over the last 5 days, and plus 0.0% over the last 30 days. This indicates extreme liquidity, which can make a short squeeze scenario complex. Squeeze requires trading activity for shorts to cover. Squeeze mechanics explained. So, how does this high cost to borrow connect to a short squeeze? Imagine a situation where many short sellers are paying an exorbitant 932.3% to remain short on GITS. If something positive happens, perhaps unexpected news, a large buy order, or general market sentiment shifts, the stock price starts to rise. As the price goes up, and especially with such a high cost to borrow, the pressure on those short sellers intensifies. They start losing money on their short positions, and the daily cost of holding those positions becomes unsustainable. To cut their losses or reduce their borrowing fees, they are forced to cover their shorts, which means buying back shares in the open market. This buying pressure, especially from a limited float of 2.4 million shares for GITS, can rapidly drive the price even higher, forcing more short sellers to cover, creating a cascading effect known as a short squeeze. Dilution risk check. Now let's talk about a critical factor that can make or break a short squeeze thesis: dilution. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This typically dilutes the value of existing shares and can completely negate any upward price momentum, even if there's high short interest. For GITS, we've conducted our dilution risk check and found no recent dilutive SEC filings, such as -1, -3, or 424B, in the last 90 days. This is a positive sign, as it suggests the company hasn't recently flooded the market with new shares that could absorb short covering or depress the price. Similarly, we found no recent reverse splits for GITS in our look-back window, which can sometimes be a precursor to dilution or indicate financial distress. Again, it's crucial to remember that a high cost to borrow, even one as extreme as 932.3% for GITS, does not guarantee a squeeze. It can also signify that short sellers have incredibly strong conviction that the company is fundamentally overvalued or faces significant headwinds, and they are willing to pay a premium to maintain their bearish bet. The lack of trading volume in GITS also presents unique challenges for typical squeeze dynamics. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For GITS, despite the zero trading activity recently, the key takeaway is that astronomical 932.3% cost to borrow. This indicates an extreme scarcity of shares to lend, suggesting there are potentially shorts trapped or a strong belief in further downside. What you would want to watch for is a sudden increase in trading volume. Any significant buying interest, even a small amount given the 2.4 million share float, could potentially ignite some movement. Monitor for any news out of GITS that could alter market sentiment, and keep an eye on any changes in their cost to borrow rate or available shares to borrow. In summary, GITS presents a fascinating case with its incredibly high 932.3% cost to borrow and microcap status with a tight 2.4 million share float, all while currently exhibiting zero trading volume. While the ingredients for extreme short seller pressure are present, the current lack of market activity means traditional squeeze mechanics aren't currently active. This is a stock to keep on your watch list purely from an educational perspective to observe if and how that high CTB translates into future price action should volume re-emerge. If you found this deep dive into GITS informative, please smash that like button, subscribe to our channel for more hard to borrow stock education, and let us know in the comments below what other stocks you'd like us to analyze. Thanks for watching, and we'll see you in the next video.